All right, today we're breaking down a company that is, well, pretty much everywhere in the global food system, even if you don't know it. We're talking about Archer Daniels Midland, or ADM.
Seriously, you have probably interacted with something they've made today, and you wouldn't even have a clue. ADM is this invisible giant that takes crops and turns them into all sorts of ingredients that end up in your food, in animal feed, and even in biofuels.
So here's the big question we're tackling today. Is ADM a solid long-term investment, or is the stock just a bit too expensive right now? We're going to figure that out by digging into a really thorough analysis from Save Invest Compound. So let's get right to it.
Okay, first things first, what does ADM actually do? Well, they're not farmers, and you're not going to see the ADM brand on a bag of chips. Think of them as the critical middleman, the essential link that connects the world's farms to your kitchen.
They run this absolutely massive global network to source, store, ship, and process all these raw commodities. It's kind of like they own the toll roads for the world's food supply. They make their money from the sheer volume of stuff that passes through their system and the little bits of profit they can skim off the top.
And when I say massive, I mean it. We are talking over $80 billion in revenue a year. But, and this is a really big but for a business like this, there's a catch.
Even with all that money coming in, their net profit margin is just razor thin, a little over 1%. And, this is the light bulb moment. This is exactly why their scale has to be so gigantic. If you're only making about a penny for every dollar in sales, the only path to big profits is to sell an unbelievable amount of stuff. It's all about volume, not high prices.
Okay, so we've got a massive company with tiny margins. How does that stack up as an investment? Well, let's jump into the deep dive analysis and see what it tells us.
So, on the plus side, the analysis points to some real strengths. ADM's competitive advantage, what investors call its moat, is its incredible scale. Trying to build a logistics network like theirs from scratch would be insanely difficult and expensive. It also spits out a ton of cash and has a pretty healthy balance sheet. But on the flip side, there are some pretty big concerns. This business is super cyclical. That means its profits can swing up and down like crazy depending on the price of corn and soybeans, and they have zero control over that. We're also seeing some inconsistent growth and a weak return on equity, which is just a fancy way of saying they aren't all that efficient at turning shareholder money into more profit. So you've got this real tug-of-war between the good and the bad.
So how in the world do you weigh all of that to figure out what the stock is actually worth? Well, this is where the analysis gets really helpful, because it takes all these ideas and turns them into actual numbers.
Okay, so this is a weighted SWOT analysis. Strengths, weaknesses, opportunities, and threats. And after everything is tallied up, ADM gets a score of 5.25 out of 10. You can see how the biggest factors like its global scale on the plus side and its cyclical earnings on the minus side get the most weight. Honestly, this score just screams average. It perfectly shows how its big strengths are being held back by some major risks.
So we have what looks like a perfectly average company, but what does that actually mean for its stock price? Let's get to the bottom line here. What is this thing really worth?
The analysis comes up with an average intrinsic value of $51 per share. Now, what's intrinsic value? Just think of it as the true value of the business, based on all the cash it's expected to make in the future, completely separate from the wild day-to-day swings of the stock market. Now, keep that $51 number in your head.
And here's where the rubber meets the road. At the time of this analysis, the stock was actually trading for over $70 a share. That is a huge gap between its estimated true value of $51 and its market price, which strongly suggests that the stock was pretty overvalued.
And get this, even in a really optimistic best-case scenario, what they call the bull case, the analysis only gets the value up to around $70. So if you're buying at that price, you're pretty much betting that absolutely everything has to go perfectly for the company, leaving you no room for error. That's what investors call having no margin of safety.
So if the stock seems overvalued, then what is a good price to buy it at? This is where the analysis gets super practical because it helps you figure that out based on your own goals as an investor. The analyst is super clear about their personal goal here. They want to earn an average return of 9% per year over 16 years. So every calculation from here on out is designed to answer one question. What price makes that specific goal possible? And this table is an amazing tool. Let's look for that goal. See the highlighted row? To hit that 9% annual return, you would need to buy the stock at around $46 a share. I mean, that's a whole different world from that $70 market price, isn't it?
Well, what if you're not planning to hold the stock for that long? As you can see here, even if you only have a 5-year timeline, you'd still need to buy the stock at $58 to hit that same 9% return. And that's still way below the market price at the time of the analysis.
So, what's the big takeaway from all of this? Let's wrap it up and pull together the final verdict.
Okay, so here's the bottom line. ADM is absolutely a solid, important company with a real competitive advantage, no doubt about it. But it is also a very cyclical business with super thin profit margins. It seems like the stock price was baking in a lot of good news that hadn't happened yet, which made it look pretty expensive. For anyone looking for a strong return, the main takeaway here is probably patience. You might want to wait for a much better entry point, maybe somewhere down in that $45 to $50 range.
And that's our deep dive on Archer Daniels Midland. I'd love to know what you think. Is ADM on your radar? Drop a comment below and definitely let me know which company you'd like to see us break down next. Thanks for watching.